Welcome to the latest Motley Fool scoreboard. I'm on Chocolate Balloon. We've got longtime fools, Jason Hall and John Quast, giving a 1 to 10 rating to a top 200 stock in the primary Hidden Gems database. It's Credo Technology Group, ticker symbol CRDO. Rate the strength of Credo's business first, including factors like industry and competition. 10's invincible, a 1 is hopeless. Jason's at a 7. John, you're at an 8.
Yeah, I am. And you look at the last 5 years, Credo has grown twice as fast as NVIDIA. I think there's your headline. You know, we're talking about everything needing to be faster and faster in the age of AI, but just as a chain is only as strong as its weakest link, so too AI is only as fast as its slowest link. And what Credo does is provide these connecting solutions between GPUs, but even between GPU clusters. We're talking 10,000 GPUs on one side connecting to 10,000 GPUs on the other side. That is a really important thing to do, and if that connection is slow, the whole thing is slow. So Credo is providing those solutions that are really cutting edge. We're at the 1.6 trillion bytes right now, working on the 3.2 trillion. So that's really going to keep it in the front of the pack when it comes to this kind of technology. And as far as I'm concerned, the data center trend is not slowing down. I do believe that the hyperscalers continue to push as fast as they can, and even upgrading the equipment within the data centers is going to be a long-term trend. So I think that Credo has an excellent business here and wonderful positioning.
Yeah, directionally, I agree. The reason I'm a little bit lower, though, is the secular demand story is extraordinary. And like John said, I think it's going to be lasting. But there's a race to innovate here. Any IP advantages companies develop here are fleeting, and they rarely last beyond a couple of generations of product. And that means this company is constantly competing to stay ahead. And it competes against some real giants that have more resources. And I don't think that means it's necessarily a risky investment. It does mean that there will be pressures, that it has to work harder to stay where it is. It has to constantly be running to win.
Jason, you mentioned large competitors. Is that like Broadcom and Marvell?
Yeah, no, that's exactly right. Those are two very, very fierce competitors that are in this space, but also especially Broadcom, in a lot of other spaces as well.
Right on. All right, let's move on to management. A 10 is Warren Buffett. A 1 is Homer Simpson. Both of you have 7s, John.
Yeah, this management team has largely been together for a long time, and CEO Bill Brennan been in this position since December of 2013. So everything that we've seen recently with Credo, that is a result of this management team, and the growth speaks for itself. I mean, it really does. I dinged this management team because of stock-based compensation. Over the last 5 years, it's averaged 15% of revenue. To me, that's too high. It has lifted the share count materially over that time frame, so that does dilute the shareholder value just enough to ding the score.
Yeah, same score, and really for the same reasons. Dilution gets wallpapered over by great results, but the results aren't there. Retail investors pay the price of that dilution. But what I wanted to highlight is this is a rare business in the fact that if you look at a 20-plus-year-old company that still has 2 co-founders as executives and neither one is the CEO, you don't see that a lot. It takes a lot of self-awareness to know maybe you're not the right person to be in the big chair and to leverage your strengths. Lawrence Ching is the Chief Technology Officer. Joe Blam is COO. They're also both on the board. And then Bill Brennan, who's the CEO, has been the chairman for about a year. He's been like John Massan, the CEO for a long time. But Lip Bhutan was the chairman. That says a lot about the quality of this business. And of course, he stepped down about a year ago to take the top job at Intel. Deeply tenured, invested leaders. They've kept Credo racing ahead and winning customers over the years.
For financials, a 10 is a fortress, a 1 is yikes. Jason's at an 8. John, you're at a 7.
Yeah, the balance sheet looks good. The debt is inconsequential, over $1 billion in cash. That looks good. What I can't believe about this business is that revenue growth has been outstanding, but it's still potentially accelerating. So possibly looking at 80% growth here in the coming year, I mean, that's just otherworldly. And you look at how it is structured, it is a fabless semiconductor company, and what that does allow is the potential for very high margins, especially in a situation like this where demand is very strong. And so around 35% margin right now, it's not impossible that it could hit 50% in the coming years. So, I mean, really great business.
Yeah, not really too much to add there beyond just there is some risk of margin compression if demand growth softens. because that's when price competition starts to ramp up. But the business is built using contract manufacturing, having a very clean balance sheet, tons of cash that it can compete really in any environment.
All right, Jason, let's talk about valuation. How well will Credo's stock do over the next 5 years, and how safe is it? 10's a sure thing, one's a lottery ticket.
Yeah, I'm pretty optimistic here. 10 to 15% annualized returns. Safety score is a 6. You look at the multiple of 37 times trailing sales. That's not earnings. 37 times sales. And it sounds terrifying. But like John said earlier, management's calling for 80% revenue growth for the full year. 30 times sales is a lot cheaper when you're growing your revenue at that kind of rate. Margins are holding up very well, could improve, like John also talked about. Demand is extraordinarily strong. I think it's going to do really well the next few years, while there is the risk that the demand growth cycle does slow. If that happens before the market is really anticipating it will, the stock could come back down to earth really, really quickly.
You know, I wish that we had done this episode just a few months ago, because I think I would have had a much higher annual return score. I'm at 5 to 10% here, and the reason for that is this is a stock that I own. This is one that I thought about the valuation. I could see this reasonably becoming a $65 billion market cap company or so. We're already over 50 billion right now. The stock has nearly doubled year to date in 2026. So to me, that kind of does cap the upside here. As you point out, the valuation is very high, and based on where I think the business could be within the next 5 years. But as far as safety goes, I am at a 6 here, which may seem contradictory to some of my high scores here, but I agree with Jason. The competition is real, and it is from very big, powerful players such as Marvell, such as Broadcom, and so that does lower the safety score for me here.
Thank you to both John and to Jason. They've given Credo Technology Group an all right overall score of 6.9 out of 10. For top hits, John has none, but Jason prefers Broadcom for its optionality and for its diversified business. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Vertex Pharmaceuticals. Till then, Fool on.
John, when you were a kid, did you get bottled Coca-Cola and pour your Planters peanuts inside the Coca-Cola? You remember that?
Yeah, inside the Coca-Cola. You said it right.
Yeah, Coca-Cola. That's right.
Yeah.
What happens? Is it like a Mentos thing? Or
No, you drink it and then you've got some peanuts.
You're like chewing the peanuts while you drink the Coke. It's like, what? It's like, that's just what we did. No one knows why.
Yeah, nobody knows why.